Hi, this is Karen Metcalf, one of the owners of Eberhard Accounting and Tax Services, bringing you a fabulous tax tip. This is where we take our years of experience and explain the IRS tax laws, rules, and changes in plain English for the average person. Today's tax tip is on choosing your business entity and why it makes sense for tax purposes. There are 4 general types of business entities. I'm going to be speaking about the tax situation regarding these. I am not a lawyer, so please consult a lawyer for legal questions. The first one is the sole proprietorship. This is owned by one person. The partnership is similar to the sole proprietorship, but it's used for 2 or more people. A corporation can be one person or more people. It can even be other entities as shareholders of the corporation. The limited liability company is kind of a weird hybrid that we'll get into a little bit later. In addition to those 4 general types of businesses, there are also non-for-profit businesses and hobby businesses. We will be discussing those in another tax tip on another day. The sole proprietorship is reported on your personal 1040 tax return. I like this because it's very simple and very basic. You're not required to keep personal and business funds separate. So as long as you keep track of the money that the company earns and the expenses that you incur for the business, doesn't matter which bank account, which checking account, where the money came, where the money went. You're not required to use balance sheets or keep track of loans and equity. Any money that you put into the business, you keep track of what you spent it on. You don't have to keep track of how much the company owes you. It's a good idea to be financially sound to keep track of these kinds of things, but you're not required to. Any losses may be able to offset your other personal income. So if you had wages, maybe $50,000 worth of wages and $1,000 loss on your business, you're only paying income tax on $49,000 worth of income. It gets to subtract, but you also add all your income from the sole proprietorship after you subtract the expenses. So if you had $50,000 worth of wages and then you had $100,000 of business income, you get to subtract, say, $75,000 of expenses, leaving you with a $25,000 profit, and that entire $25,000 profit gets put on your income tax return along with your wages so that you have $75,000 worth of taxable income. All the profits from the sole proprietorship, after you subtract your expenses, are considered self-employment income. That means you need to pay self-employment tax if you're not over the self-employment limits. So you're paying income tax and you're paying self-employment tax, and there's a form to go with your individual tax return, so it all gets done in your nice, neat package with your personal tax return. And this is generally owned by one person. A partnership is reported on a 1065 partnership tax return. This is usually for people that want to go into business together. I see this a lot where you've got a parent and an adult child joining together to start a business. You may have brothers and sisters that are trying to get together and do a business. They basically pool their monies. You can have people that don't pay in the same amount of money. So maybe the mom is putting in $10,000 and the daughter is going to be the one that's knocking on doors trying to sell the product. There's no payroll or wages paid to the partners. The partners get their share of the profits or losses reported on their own tax returns. So the partnership totals up all the income and then subtracts all the expenses and puts the bottom total, whether it's a loss or a profit, on a K1, and the K1 is given to the partners, so the partners can use that bottom line number on their tax return. So it doesn't work really well for partners to be paying some of this out of their own pocket. It should run all through the partnership checking account to make it simple, or at least recorded so that the partnership is doing a good job of keeping track of the money from all the partners. There's extra record keeping involved here because the people are putting in different amounts of money and different amounts of things. So the basis is required to keep track of by the IRS. The basis is generally what you put into the company and then your profits and loss going forward. So if someone put in $10,000 and the company lost $1,000 and they're a 50% owner, they get a $500 loss, and then they have the 10,000 they put in. So then their basis is now 9,500 because they got to use the $500 loss on their tax return. You can have people with different percentages. So you can say we're 50-50, or you can say you're 25 and I'm 75, or you can have 5 people that are all 20%. So the profits and losses are divided among people based on their ownership, and that should be hammered out in the beginning with a legal document saying who's getting what share and why. All the profits that you get in the business are 100% self-employment income. So if the company made $5,000 and there's 5 partners, every one of them, and they're even, would get the $1,000 on their tax return, and it would be subject to self-employment income. Corporations are further divided into 2 separate types of corporations, and the only difference is how the taxes are treated for the corporations. The C corporation is your standard A1/1 corporation is formed in your state. In fact, the S corporation has to start out as a C corporation because at the state level, there's only one corporation being formed. To get to be an S corporation, you actually file a special election with the Internal Revenue Service after your C corp is formed. It's supposed to be done within 60 days of the beginning of the business year. So if you didn't file it the first year that you were formed, you can actually decide to be an S corp 5 years down the road if you meet the qualifications and file an election at that point. C corporations are filed with a 1120 corporate tax return. One of the differences between corporations and the other 2 entities we talked about is the owners get paid payroll and wages, and they get a W-2 at the end of the year for their time in the company. If they are not working for the company and they're just a shareholder, they won't get wages. All profits and losses are taxed to the corporation. So the corporation has its income, pays its expenses, and then pays taxes on the profits in the business. After the taxes are paid on the profits, then the corporation may issue dividends to all the stockholders. These are also taxed to the stockholder. So this usually results in a double taxation of the profits. Payroll reports and extra record keeping is required for a C Corp versus a partnership or a sole proprietorship. So this can get a little complicated. The S Corporation is reported on 1120 S Corporation. Most of the similarities between a C Corp and an S Corp are the same because they're the same legal entity. The difference comes in the taxation. So on the S Corp, there is no tax at the corporation level unless you've in Illinois and you get a little replacement tax. But what's supposed to happen is all the profit and losses get calculated on the corporation tax return, and then it gets distributed or flows through to the shareholders. So the shareholders will get a K1 similar to a partnership K1 that says this is your share of the profits and losses in the corporation. By doing this, the tax is passed through to the shareholder and is not taxed at the corporation level. So if one shareholder's in a high tax bracket, they may end up paying more tax than a shareholder that's in a lower tax bracket. Distributions are similar to dividends, but they're not dividends. So after the profits are figured out in the corporation, the S corporation can choose to pay out money to the stockholders, and these are distributions, but they are not taxed again to the shareholder. They're just giving you your share of the money and the profits in the business. So they are not taxed as dividends, so the only tax is the profit of the business, and if the business had a loss, they generally get the losses on their tax return, so this results in no double taxation. What's interesting is this is sometimes called a small corporation because there's special rules for an S corp only allow about 100 people to be shareholders, so you can't have a huge company with lots and lots of shareholders. So General Motors and those big companies cannot elect to be an S corporation. All the S corporation members need to be tax-paying entities, and there's a couple other odd rules, but generally people don't run into those. It's just that it has to be a few number of taxpayers. Limited liability companies do not have their own special tax form for the IRS. They are actually reported on the 3 types of tax returns, or actually the 4 types of tax returns when you count the 2 corporation types. Limited liability companies started in 1977 because they wanted to give sole proprietorships and partnerships the same legal protection as corporations without having to have the people that were involved to actually start an S corporation or C corporation. They wanted to keep the tax benefits of being those other entities. So they created limited liability companies. So the limited liability company has default tax returns. So if you're a 1 member, it defaults to a 1040 sole proprietorship tax return. If you have 2 or more members in your limited liability company, then you default to a partnership tax return. However, you can actually elect to be taxed as an S corp or a C corp. On those tax forms, there's a special election you can fill out. So this is kind of a case of what do you want to be with the limited liability company? I see this used a lot for real estate so that people can still have the benefits for taxes from real estate on their personal return, but they get the liability protection from a corporation by having a limited liability company.